Brad Williams, Frugal Finance. How about we talk about combining options with bonds and stock? I'm going to preface this up front. We're going to have a lot of just ridiculous statistical comments. What can I say? It's your job. Sometimes it's just a matter of crunching the numbers, and I'm going to show you what we're talking about. Combining options with bonds and stocks. We now show how to combine options with stocks and bonds to adjust payoff patterns to fit virtually any taste for risk and return combinations. These combinations show us the relationship among the different classes of securities. By combining two types of securities, we can generally imitate the payoff pattern of a third. In this course, we look at a number of combinations. One, we're going to look at it's like a covered call. A covered call is a long position in an underlying stock and a short position in a call option. It's an investment enhancement tool. Second, we explore portfolio insurance. Again, it's just a one-off of what we talked about earlier. And I'm going to bury you with just some probabilities, and you're going to be overwhelmed, and you're probably going to fall asleep, because I'm probably going to fall asleep, because it is rather, well, boring, but it will be your job, perhaps. And if so, I'll just throw some hypotheticals your way. We're going to look at some basic ideas for portfolio insurance by showing how to insure a stock portfolio. Third, as we move forward, not in this session, but maybe in the next session, we'll demonstrate how to use options to imitate profit and loss patterns. And then if not, then it will be in the next set of courses in the options session. And then for investors who do not want to invest the full purchase price of a stock, it is possible to create an option position that gives a profit and loss pattern much like the stock itself. And fourth, eventually we'll be creating some synthetics. By combining options with the risk-free bond, we can mimic the underlying stock. In this example, the option and bond position generates the same profit and loss pattern as the stock, and it's the same value as the stock as well. Lastly, we'll show how to combine a call, a bond, and a share of stock to create a synthetic put option. In this session, because it does get a little lengthy, I'm just going to show you the covered call and the portfolio insurance, and then we'll move on from there. In short, in a covered call transaction, a trader generally is assumed to already own a stock and writes a call option on the underlying stock. The strategy is covered because the trader owns the underlying stock, and this stock covers the obligation inherent in writing the call. In other words, they are going to sell the call. You're going to buy it. You're going to give them $4. In the event that the stock does not move above the strike price, then the seller is going to keep the $4 and you lost your $4. Yeah, it's options. Remember, 80% of options traders lose money. Keep that in mind. The strategy is generally undertaken as an income enhancement technique. Why? I think I just displayed why. For example, assume a trader owns a share, currently priced at 100. She might write a call option 110. The price is $4. The option premium will be hers to keep. In exchange for accepting the $4 premium, our trader realizes that the underlying stock might be called away from her if the stock exceeds 110. If the stock price fails to increase by 10, the option she has written will expire worthless and she'll keep the income. Although writing covered calls can often serve the purpose of enhancing income, it must be remembered that there's no free lunch in the options market. The writer of the covered call is actually exchanging the chance of large gains on the stock position in favor of income for selling the option. And here's a graph. Here's your ceiling if you decide to do that covered call. Stock could go to 500, and guess what? You're going to only get that $4. It is a risky bet. If the stock goes to 500, your stock's going to be called away from you. It could be a double-edged sword. Just be aware of that. You can read this. I just explained to you what's going on here. In terms of portfolio insurance, you know the basics of portfolio insurance. You have a $50 million portfolio. You either A, you sell futures, the hedge ratio and all that, and you can play with the beta and you can do all kinds of different strategies. But you can also buy puts, and you can create whatever you want in terms of strategy using puts. The cost, to keep in mind that options are costly, whereas if you buy futures, it's up to you as a portfolio manager to decide what works for you. So anyway, Along with program trading, portfolio insurance was a dominant investing technique developed in the 80s. Portfolio insurance is an investment management technique designed to protect a stock portfolio from severe drops in value. Investment managers can implement portfolio insurance strategies in various ways. Some use options, while others use futures, and still others use combinations of other instruments. We analyze a simple strategy for implementing portfolio insurance with options. Portfolio insurance applies only to portfolios, not individual stock. Therefore, for our discussion, we will assume that the underlying good is a well-diversified portfolio of common stocks. And how about we just use the S&P 100 just for convenience? In essence, portfolio insurance with options involves holding a stock portfolio and buying a put option on the portfolio. If we have a long position in the stock portfolio, profit and losses from holding the portfolio consist of the profits and losses from the individual stocks. Therefore, profit and losses for the portfolio resemble typical stock profits and losses. Let S of T be the cost of the stock portfolio at time T, and let P of T be a put option on the portfolio. The cost of an insured portfolio is therefore S of T plus P of T. Because the price of a put is always positive, it's clear that an insured portfolio costs more than the uninsured stock portfolio alone. At expiration, the value of the insured portfolio is S of T plus P of T is equal S of T max. That max is whatever it costs for or options. As the profit of an uninsured portfolio is S of T minus S of T, the insured portfolio superior performance when S of T is okay. As an example of an insured portfolio, consider an investment in the stock index at a value of 96. Figure 1122 right here shows the profit and loss profiles of an investment in the stock at 96. And for a put option on the index. Figure assumes that the put has a strike price of 96 and a cost of $4. We're expressing all values in terms of the index. Figure 1123 down here shows the effects of combining an investment in index stock and buying a put on the index. For comparison, figure 1123 also shows the profit and losses from a long position in the index itself. Index by itself, the long short position. I say short position, not really short. If you're buying a put, you're going to be long the put, but you're still quasi-short. So you're going to see what the outcome is. We're going to go through, we're going to use some hypotheticals. As a further comparison, we consider the likely returns profit, the likely returns profit from holding the stock portfolio and insured portfolio. Assume that the options expire in 1 year. The stock portfolio returns are normally distributed with 10% return and a standard deviation of returns of 15% as shown in 1124 right here. Is this all foreign to you? Sorry, you got to go pick up a stats book. I'm not going to teach stats here. We have 10% return, standard deviation 15%. There's an approximate 68% chance that the returns will lie between 5% and 25%. Here to here. I don't know if the drawings here are correct. Right here, 4% probability, 5 and 25. 68%, I don't see two standard deviations. So just go with this. They're saying two standard deviations is 68%. Negative 5% plus 25%. That's kind of crappy. That's really noisy, really noisy. Do you do something crazy? I mean, that's just too much variation. Negative 5 to 25, 68% chance. For the insured portfolio, we noted that the maximum loss is 4. So the terminal value must be at least 96. A loss of 4, negative 4, 5 by 100 equals negative 4%. Figure 11, 23, and 24 imply that there's a good chance that the insured portfolio will actually lose this 4%. Any return of 0 or less on the stock portfolio gives a negative 4% return for the insured portfolio. The chance of that the stock portfolio will have a 0 or lower return equals the chance that the stock portfolio will have a return that is 2/3 of the standard deviation below its mean return at 10%. I'm not going through it. You can read it. Bottom line here is, and this is not a stats class. This is important. I'm taking it with a grain of salt just because it's too heavy in terms of understanding. Maybe down the road I'll explain this in detail. The bottom line here, the portfolio insurance example emphasizes the role of options in adjusting the returns distribution for the underlying investment. With options, we can adjust the distribution to fit our tastes, subject to the risk and return trade-off governing the entire market. Finally, we note that the insured portfolio has the same profit and losses as a call option with a strike price of 96 and a premium of 4. This does not mean, however, that the insured portfolio as such a call option would have the same value. At expiration, the call will have no residual value beyond its profit and loss at the moment. By contrast, the insured portfolio will include the value of the investment in the stock index. Therefore, for a particular time horizon, two different investments can have the same profit and loss patterns without having the same value. I know I kind of sidestepped this because we might be walking into an area that needs a heck of a lot more explanation, and I don't have a stats course built into Frugal Finance. And I know it's critical within finance to have a strong understanding of statistics. With that being said, if you as a group collectively want me to provide more in terms of statistical analysis, I will, but it better be a huge request because it takes a lot of work and I have way too many things to do. With that being said, Brad Williams, Frugal Finance, more to come.